All right, guys, we're here to talk about mortgage loans once again and that pesky little thing called PMI. So what exactly is PMI? Does everybody have to pay it? And I want to talk about creative ways around it in today's episode. PMI, also known as mortgage insurance, is the insurance premium that you as the borrower pay in order to protect your lender in the event that you default on your primary mortgage and your home ends up going into foreclosure. PMI is required when a borrower is unable to provide the typical 20% down payment of the property's purchase price when you're applying for your mortgage. Now, this is because the lenders are going to obviously look at this scenario as a riskier investment for themselves and will thus require the borrower to take out PMI. Now, although the PMI payment is usually paid monthly as part of the overall mortgage payment to the lender, it can in some cases be paid in full upfront along with the loan to keep the monthly costs down. So that may benefit your cash flow and you should at least evaluate that option. This is going to be taken out from your down payment though, which makes your down payment smaller. Once you as the borrower have paid the equivalent of that 20% down payment toward the principal amount of your loan, then you can actually contact your lender and ask that the PMI payment be removed. A great way to do this is by paying more toward the principal balance each month, including using debt weapons. Debt weapons have been widely accepted as one of the easiest ways to avoid your mortgage insurance because guess what? We can apply a lump sum payment toward your existing first mortgage, thereby increasing widely your equity position and giving that mortgage lender the comfort to actually remove your PMI. So there is another practice to avoid PMI known as piggybacking. It is not to be confused with the piggybacking method that we talked about regarding jump starting your credit, which is also known as the authorized user technique. This form of piggybacking is done by taking out a smaller loan in second lien position, which typically comes out with a higher interest rate, of course, to protect that lender because the combined loan to value of both loans is much higher and riskier. And that will then cover the amount of the 20% down, or if you have 5%, you could get a second for 15, or if you have a 10% down payment, you could get your second to cover the additional 10% and have an 80% first along with that 10 or 15% second. That will allow you to commit yourself to two loans, but because the funds are used to cover that down payment, you're not then required to pay the PMI. What a great way to avoid it. Borrowers can typically deduct also the interest on both of those loans on your federal tax returns if you're itemizing deductions. For more information on that, make sure you check out all of our videos regarding lending and how you can start to turn the banks against themselves. We look forward to seeing you on the next video. Until then, make it a great day.